Yeah, the correct one's in Blackboard. All right. Well, sorry about that, guys. Okay, tonight we're going to start the chapter 12 handout, and this is on sometimes called current liabilities. Sometimes called operating liabilities. And basically tonight we're going to look at notes payable, which you guys I know have done before, and then we're going to get into warranty stuff, which is a little bit trickier, but not too bad. Is there anyone that does not have it? Does not have a chapter 12? Actually, if you use the chapter 1 that's marked chapter 13, it's exactly the same. It's just got a different title on it, and it's the wrong chapter.
Should we keep the chapter 13 one, or can we delete it?
Delete it. If you have the chapter 12, they're actually identical, but to avoid confusion, because there is going to be a real chapter 13. And so the question becomes, well, what chapter 13 are you talking about? So anyway, sorry about that. Okay, notes payable. And notes payable is basically, oftentimes you go to the bank and you get a note payable. Oftentimes it's used for things like inventory and stuff like that, but we're just going to look at the nuts and bolts of the liability part of it. Okay. So, and I know you guys have already done this before. On January 1st, ABC Corporation receives $12,000 cash for signing a 3-month note. The note carries an interest rate of 10%, make necessary journal entries. Okay. So when we first sign the note, what's going to happen?
Cash is going to increase, note payable is going to increase.
Yep. So cash is an asset, it's increasing. And notes payable, liability, and it's also increasing. By the way, I do have the very bottom of this thing. This kind of shows you, what goes up and what goes down. So for instance, here we got cash. Cash is an asset. It's increasing with a debit. Notes payable is a liability. So it's increasing with a credit. So this is kind of a little, it's kind of amazing that everything in accounting kind of fits into these kind of five kind of categories we have here. And these almost always are only the increase. These almost never have those. So it's even easier than that usually. I mean, unless something weird happens and you decrease your expenses, if you overpay a phone bill or something and they send you a check back, I guess. But for the most part, expenses are always going to be debits and sales are always going to be credits. 99.9% of the time, that's going to be right. All right. Okay, make the necessary journal entry on March 31st for the payment. So the question is, how much are we going to pay? Let me do one more, phrase it a little differently. How much interest are we going to pay? Oops, all right, interest, equals, well, we borrowed, $100 or $12,000. The interest rate is 10%. And this was by the way, the interest rates, these are always given annually. By law, they have to be given annually. So this is for the entire year, but we only had it for 3 months. So we're gonna multiply this by 3 of the 12 months that we had it. Time for us to calculator.
$300.
Could be. You're faster than I am. Yes, it is 300. I gotta get speedier. So yeah, so this is the interest that we're gonna have to pay is 300. All right, so what's the journal entry gonna look like?
You're gonna debit note payable 12,000,
Yep.
debit interest expense 300, and then cash 12,300.
So this is a liability going down. We're now paying it off for 12,000. We have interest expense, and this is interest expense for. Never say always debits. This is the interest expense. It's all, and they don't even say what year it is. It doesn't matter. It's in the same year. 300, and then we're going to write them a check for the note payable. Asset going down. 12,000 plus the interest 300. So it's kind of a straightforward note payable. Question on that thing? Okay, let's go down to this one. All right, on November 1st, received $20,000 cash, signing a 5-month note. Okay, this is gonna be the same thing as the other one for the first entry then. It'll be. Cash is going up. You have to write this in, by the way, the asset plus thing, you know, put that. 20,000. Liability is also going up. We now owe 20,000. I'm not sure why I have such generous journal entry forms here. This is kind of large. But all right. So this is a 5-month note. Now, we wrote this note, we signed this note, I should say, on 11/1. But our year end falls on 12/31. Now, this is a 5-month note. So we're not going to pay it off on 12/31. But we're going to owe some money on that date. And they'll call this accrued interest. Now, accrued just means it hasn't, the dollars haven't been paid yet. It's sort of like this. There are two types of basically transactions that will no, not me. Yeah. We need light on the other camera. There are really two types of transactions. A lot of times we'll have to make adjustments for, and the ones that are talking about here, the accruals, are when something has happened but the money hasn't been paid yet. There's also a thing called deferrals, and that's when the money's been paid but the transaction hasn't been happening yet. So for instance, prepaid things are deferrals. Things that aren't paid yet are accruals. You know, so this interest we haven't paid yet, but we have to accrue for it. So, you know, 11/1 we signed this thing, but at 12/31, at the end of that period, at the end of our year end, we owe some money. We haven't paid it yet. We're going to pay it later on, but we still owe some money for this, you know, this time in here. You see by how sloppy my writing is, that's why I don't write very much. Let's see here. Okay, so how much do we owe them on how much we owe them on December 31st?
300 in interest.
See, 20,000. Goes to the 300 again. You guys just write that down for the oh, it's all 300. Okay, and we have what, 2/12?
Yeah, it comes out to 300 again.
Sorry about that. Unhappy coincidence. Okay, what are the accounts going to be?
You debit notes or interest payable.
Close. We'll credit interest payable. Oops. I can write it. Because we owe them, it's a liability going up. Typing here. We owe them $300. And we haven't paid them yet, so you know this isn't cash. This is just we owe them. What's going to go on the other side?
Would it still be put underneath the interest expense?
Yep. So we're going to count that interest expense, and we're going to count it in the current year. I don't think I give the current year on here. Oh, I do. 2023. We're going to count it in 2023 because we basically use that cash in 2023 for 2 months. So we owe $300. So this will be the interest. That we owe them. Haven't paid them yet. Okay. Prepare the necessary journal entry for the payment of the note on April 1st, 2024. No entry was made for accrued interest on January to March of 2020. Okay. All right, so we have to pay off this note. Now, again, we have not paid anything here. This has not been paid. There's no cash going out for that. We haven't paid them any of the interest yet. So there's a couple different ways to do this one. You know, actually, we may need another row here. You might need to insert a row above here. I'm not sure. All right. Oh, let's do how much cash do we owe them? We borrowed $20,000. We borrowed it for 5 months at 9%. So let's see how much cash we owe them. So let's do the interest payment first. So 20,000 times 9% times 5/12 equals 750. I better use a calculator. Yeah, it's 750. So this is 750 of total interest. Oops. And boy, did I make a mess out of that. Let me do something here. Oh, no, I do that. All right. I don't know, right? Does cash interest maybe? Okay, so when we get to our cash account. Oops. We owe them the 20,000 plus the total for 5 months. So for 5 months. 750 cash. So the total we're gonna pay them is 20,750. Not both. All right, what are the other accounts we gotta fill in here, though? Anyone? Yeah, you guys are sleeping already? Should have for another 5 minutes.
Would interest payable go down?
Yes, we're gonna have interest payable. We're gonna pay off this 300 that we no longer owe them because now it's included in that 5 months. See, so we're gonna take that off at 300. So this is. I hope I don't mess this up. This is, let me think how to do it. I'll do it here. Now we owed them the 300. Well, now we just paid that off. What else do we owe them? So the interest payable, we definitely owe them. What other payable do we have?
Notes payable.
Yep. 20,000. Okay, our two sides do not match. Our debits don't equal our credits. What do we need? What's the magic?
Interest.
Yeah, interest expense. Yep. And this interest expense, this will be for the 3 months. You can actually calculate it if you want. You know, this would be. Going to calculate it, it'd be 20,000. Probably gonna mess this up. Times 0.09 times 3/5. Scratch it. 3/12. See, I messed it up. I knew that. Let me do something here. Okay. Yeah, so interest expense will be, you actually just do the plug number. You know, what is it gonna take to make it balance? Like 20,300 or 20,750 minus 20,300. It's 450 to make it balance. You could also multiply it out by using this. Because we had it for 3 months during the year, we had it through January, March. January, February, March, and then paid it off. We had it for 3 months out of the year. I don't know what's going on with me today. I think I had too much Benadryl. But anyway. Any questions on this one? Okay, I'm gonna keep completely silent. And see if you can work problem number 3. It's very similar to the one we just did. Be careful to count the months. So this is on December 1st. Okay, is that what you guys got?
That's what I got.
Okay, all right. And then for this one, it's interest expense. You could, you can either just plug number, try to, you make the debits equal to credits, that's fine, and that's probably the quickest way to do it. You can also multiply it out, say, okay, in 2024, we had it for 5 months. January, February, March, April, May. So you could also multiply it out and just look at that 1750. But either way is fine. Okay. All right, warranties. Our warranties, they actually come in 2 different flavors. And hey, that's not me. Not me either. Yeah, it is me, but it's a picture of me. All right, they come in 2 different flavors. And when you buy something, yeah, I know you guys all know this. You buy something and it'll come with a warranty included in it. You can also buy a warranty sometimes separate from the item. And whenever you buy something, they'll say, do you want the extended warranty? This is a 1-year warranty. Do you want the 4-year warranty? Then you pay this extra money. So those are actually 2 different things. You know, the first warranty is included with the product. Part of the product is it's included with that item. The second type of warranty is actually an unearned revenue. It's when someone pays you ahead of time and you will make repairs on whatever, the toaster or whatever it is they bought. So there's actually 2. I mean, so the first ones we're going to cover are the ones where it's included with the product. So you buy a product and it has a 1-year warranty or 2-year warranty or whatever it is. And then, you know, we'll talk about the other ones, the unearned revenue. Okay. I'm going to change this a little bit. I'm going to change this to say sales. Oops. That's what warranty was, but okay, so let's go here. So they sold $5.5 million worth of toasters for cash. These toasters include a 3-year warranty that is integral to the product, so it's included with the product. The estimated total warranty costs for 2023 were 60 for the sales are 60,000. The actual warranty costs are 14,000 for the toasters. Journal entries for the total costs and the actual costs. Okay, so we have to make a journal entry for the sales. So these are sales that are made for cash. And by the way, I have various here because there'll be sales made on, you know, January 1st all the way through December 31st probably, and so throughout the year. Okay, what would the sales for cash look like? What would the journal entry for that be?
Cash debit and sales.
Yep. So cash. Asset going up. I have enough space here. I do. So cash is going up, and then we'll have revenues. Or sales is fine. Actually, a lot of times they'll be called sales if they're actual item. So sales always go up with credits. Now, We have a thing called the matching rule that means we have to match our expenses with the sales that were generated by those expenses. Now, you'll notice that the estimated warranty cost for the next 3 years is 60,000. Now we're counting these sales in 2023. So we're also going to pick up that expense in 2023. And by the way, why do we even include that 3-year warranty? Why don't we just put no warranty on it? Yeah, you could sell it with no warranty, as is. So why do you put a warranty on it?
To make more money.
Yeah, you're more likely people are going to buy it if there's a warranty on it. And the longer the warranty, more likely you're exactly right, the more money you're going to get. So that warranty is actually on there. The whole purpose of it is to make more sales, to make more money come in, either sell more units or sell them at a higher price. So there is a reason for it. It's not just, well, I guess it could be if you're just going to try and be a good person, but it could also be that it's actually part of the sale itself. Okay, so warranty expense will be 60,000. And then probably some kind of warranty. It could be warranty obligation. I'm just gonna put warranty liability. Oops. And if you put obligation, that's fine too. You see it different ways. Then this is a liability going up, because now we sold these toasters, but we're going to have to pay off 60,000. All right. Now there is another little twist here. And that is some of the toasters, maybe we sold some in January that actually have come back already. And if the actual warranty costs are $14,000 in 2023. Okay, so let's come down here. Now, these costs, they could be in cash, it could be in parts, it could be in labor, and it's housework, etc. Whatever it is it takes to get the things back going, and that cost us 14,000. What's going to go on the other side? Yes, very good. Warranty liability. We've already have expensed this 14,000 down here, or up here, I should say. So throughout the year, when we made the journal entry, whenever we made a journal entry, we put a little bit aside for the warranty expense. So we've already expensed it. So now we're just paying off this liability. So this is part of the liability going down. So this is actually paying off part of the, part of this liability is getting paid off here. So whenever you make a sale, it will generate a liability for the warranty that goes on it. And again, we're not just doing that, well, maybe we're doing it because we're nice people, but it's also part of making the sale. You have someone insurance that, you know, hey, if things go wrong over the next 3 years, we'll replace it. And so we have this warranty liability is actually decreasing now because we basically paid off 14,000 of it. And again, it could be done in any number of, you know, without knowing the specifics, it could be any one of those things. May not even do it ourselves, maybe farm it out. Okay. So how would this be shown on the income statement? Okay, well, it would be shown under the warranty expense. It'd be shown under selling expenses. So underneath selling expenses, you would have, among other things, $60,000. Okay, the balance sheet one's a little bit trickier. How much of a liability is still left?
$46,000.
Yep. So I'm gonna make the calculation over here. So I'll say warranty left. Just the ending balance, probably a better way to put it. Okay, so it was 60,000. But we paid, or using parts or whatever, 14,000. So there's 46,000 left. Okay. So assume that $25,000 of warranty liability is current, the rest is long-term. Okay, so we're gonna have current liabilities. Is 25,000. And where is the rest of it gonna go? Probably in long-term or sometimes called non-current liabilities. Again, these are sometimes called non-current. Same thing. How much are we gonna have in our? Ah. Hey. Oops. How much are we gonna have? Well, what I do, I'm sorry, this is wrong. Stop that, stop that. This should be warranty liability. Is that why you guys are not talking to me? You knew I put it in there wrong. I don't blame you. All right. How much is gonna be in the non-current liability? Yep, very good. Thanks, Irma. And that will be the 46,000 minus 25,000. Yeah, so that's what's gonna be, and again, you know, the important thing to recognize is that the expense and the sales are gonna go in the same year. That's the matching rule. You match your revenues or your sales with your expenses for that period. And this one, it really is direct. That why do you have a warranty? You have a warranty because you want to make a sale. And people won't buy it unless you have a warranty. So, or they'll buy fewer of them, or they won't pay as much for it. Okay, let's stop here. Let's take a break. $6.59. And we'll say $7.10. Oops.
Professor, can you go back up before you walk away? Yeah, thank you.
Sure. All right, see if you can do this one on your own, just to give it a shot. Oh, this is wrong. I gotta change the number on here. Change this, 40,000 to 4,000. I'm sorry about that. Yeah, change 40,000 to 4,000. So, make that correction there, make that 4,000. Okay, any questions on that? Make sure you make, this shouldn't be 40,000, it should be 4,000. So make sure you make that change. That was an error on my part. All right, I'm gonna give this one for homework. And I think that's gonna be it for tonight, because this down here, these are the different types of, this is a different type of warranty. And these are are way different. I don't want to confuse them. So this one, so number 6 will be homework. And then we'll pick up and do the rest of these next week. So next week, let me go back to this. We'll do the sales type warranties. We'll also do some ratios. And we'll also do some textbook problems. This might be a little ambitious. And multiple choice review. And then I'll send out the exam next week. Any question on that? Okay, so so you can do number 6 on your own. And then I know most of you've already turned it in, but if you have not turned in the chapter 22 exam, try to get that in by Friday. Friday, I'll put the grades through the, you know, that'll be the due date. Actually, probably Saturday. I'll put. Well, I'm gonna put the grades through ahead of time, but the grade to date will be posted on Saturday. So any questions on any of this? So you don't have anything to turn in for this week, and I'm going to change the due date for this handout. You don't have anything to turn in for this week. So next week we'll finish up chapter 12, and then we'll have another test on it. And again, these tests are shorter for a reason. You retain more, try to do better, get better grades on them. But yeah, so if you have not done so already, see if you can get in the chapter 22 exam by Friday. Questions? All right, nice short class tonight. I will see. Let me do something really quick here. I want to check and make sure I didn't goof up the other one. Got a bad feeling now. This number 6 should be okay. I think number 6 is okay. Okay, so sorry about that. Yeah, so number 6 should be fine. So I will see you guys in a week. All right. Good night.
Thanks, Professor. Have a good night.
Perfect.
Good night.